I have this friend and they've got this great tax strategy. They have all these losses, so they hardly have to pay any taxes.
I'm not going to wake up in the morning and sit there and in a very determined way, wake up and like lose clients' money. Just not going to happen.
Yeah. I feel like we're in that lose-lose situation. We make money, we get in trouble because they owe taxes, you lose money, they're not happy,
This applies to everybody. If you're a senior level executive working for a firm or a corporation, you own a business, you're a lottery winner, this applies to everybody.
Life, money, action.
Welcome to Small Change, Big Gains, the podcast where we explore how small, intentional decisions can lead to major results in your financial life and personal growth. Whether you're looking to invest smarter, develop better habits, or simply find balance, we'll learn together how minor shifts can make a big impact. Join us as we unravel experiences, explore practical tips, and hear inspiring stories. Let's make it happen, one small change at a time towards big gains.
Welcome back, Sean.
Hi, how you doing?
It's been a long time since we've sat in these chairs.
Hello, everybody.
We're back. And what are we going to talk about today?
Today we're going to talk about how to keep more of your money. This is tax season. We're all filing our taxes. A lot of fun. And a lot of us are waking up to a tax bill, rightly or wrongly. We get into the merits of taxation and so forth. But that's not today. That's not what it's all about. What is today all about?
Today we're going to talk about how to be more proactive around your planning, right? So tax time is not going to be the time to call your accountant and start asking them about a plan. They are stressed right now. But it's a time where you're getting all those statements, all those receipts. You clearly get to see the tax bill that you're going to own, which gets people a little more motivated to do planning, which seems like a lot of homework for people, right? And the whole point is planning's not supposed to be dramatic.
No.
It's supposed to be consistent. And I think that is the key of what we're trying to bring to light today.
You want to plan in the cadence of calm.
Exactly.
And when you're working through your personal taxes, you start thinking of, if you're a business owner, perhaps your corporate year end and so forth, everything comes into play. So once you get through the I think what you're saying, if I put it in my own words, once you get through the shrillness of your own personal taxes, calm it down, and then there's a good opportunity to do some more long-term planning.
Calm it down, and we've put together a checklist, and it's something we do with clients too. It's when you're going through your reviews, checking off the things that might seem obvious at times, but when you actually step back, I'll give you a simple one. Who's the beneficiary on your TFSA or RSP? When you ask a client that, sometimes they're like, well, I think it's this, or I hope I did that.
And do you have your beneficiaries on your TFSA properly?
Or on your insurance policies. And so when you ask the question, if you're sitting there doubting it, that's not a good place to be in. So by going through each year going, okay, this is who I have. Yes, I've done that. On to the next thing. It gives you that peace. And then to really know strategically, okay, what are the one or two things I'm going to work on?
Let me ask you a question. Why is that important? You mentioned TFSA. Why is it important to make sure that your beneficiary designation is correct on the TFSA?
Well, because one of the most common things we get is, say you name your spouse, which is kind of the smart thing to do, because if you name your spouse, it has to be the successor, not just the beneficiary.
That was a loaded question, by the way, Amy. I was leaning you that way.
But oftentimes people will name their spouse as the beneficiary, which means if they pass on, you get the money, but it doesn't get to roll into your tax-free savings account like a successor rollover would.
Right.
So it's really, really important, because you're keeping a big chunk of money, call it around $200,000, that just rolls in and continues to grow tax-free. So that's just a little tiny thing that just going through a checklist, going, yep, I've done it, because then you catch all those little leakages all over the place. And we see that. We work with a lot of business owners, and time again, when we sit down, they run. I'll give you an example. Last week I was out meeting with one very successful business. Looks like they're on track to probably have a record year this year, which is phenomenal. But when I started asking the questions, do you have a will? I think I finished it, or is it still in draft? And both the CFO and the owner looked at each other and went, not really sure. What about the insurance policy? I'm not sure. And the more you went through it, you could just see that kind of anxiety and that worry. Again, running a phenomenal business, but lots of gaps on the personal side. So it's bridging that gap is so important.
I think one of the key things you can do when you're looking at your annual, what we're talking about really is an annual tax and wealth review checklist. That's really what we're talking about. And one of the things you want to really focus on is really, and again, if you look at Canadian taxation, it's complicated. And rightly or wrongly, we're in one of the higher tax jurisdictions in the world. We just are, okay? So you really have to have a working knowledge. You don't have to be expert like an accountant or a financial advisor or so forth, but you need to be conversant enough to understand the difference between three things. One, what is tax-free?
Yes.
Two,
not many things are tax-free.
There isn't, but they're out there. They're out there.
A few, yes.
Okay. Two, what is a tax write-off? What's the difference between tax-free and a tax write-off? And then third, what is a tax deferral?
Right.
And what are the differences between the three? And then intelligently and thoughtfully allocate your resources to take advantage of all three.
Absolutely.
You can't get everything, to your point, tax-free.
No.
It ain't gonna happen.
No.
Nor do you want to have everything in a tax deferral,
Yeah.
because you're going to wake up at a certain period of time. I'm going to get into that in a moment. Where at some point you're going to have to pay. And then you got to understand, what is a tax write-off?
Yeah.
And a tax write-off, simply put, is you write it off in the year that you take the tax deduction, and it's done. It's forever gone.
Yeah.
Okay. There's no pay the piper down the road.
Right.
Tax-free, in its simplest form, is you invest in something and it's tax-free. TFSA is the most obvious example of that.
Right.
Tax deferral would be anything from an RSP contribution. Anybody that has these great corporate structures, guess what, folks? That's a tax deferral. Okay? Trusts, tax deferral mechanisms, so on and so forth.
Yeah.
Right?
Yeah.
Tax write-off would be a political contribution, charitable contribution, and so forth.
Yeah.
But it's more complicated than that, but in the simplest form, that's what that is.
Well, and I think by going through a checklist, it highlights where maybe some gaps and some opportunities will lie. So that, again, not at the moment with your accountant today.
Not today.
Not today. We know a lot of accountants get bombarded with, well, should I have taken a salary or a dividend? I'm like, well, we can't make that as you're filing taxes. So tax planning and tax filing, two different things, two different times.
And you need to do another two things when you're doing the annual review. One is understand your enterprise value. That is your total value of your assets, including your debt, by the way.
Yes.
Then understanding that of that debt that you may have, what is what I would describe as performing debt.
Right.
That is debt that's making you money, or other people are paying it for you.
Yeah.
And what debt are you personally paying, and what's the benefit of it?
Right.
And making sure your cost of capital, folks, that's interest rates.
Yeah.
Your cost of capital is appropriate for the level of debt you have. And what is your debt to equity ratio? And here's why I bring that up.
Right.
One, when we started working with people 15, 20 years ago, and we did planning for them, we basically were working with them when they had net worth between, let's say, $1 and $5 million.
Yeah.
Okay?
Yeah.
And we were saying, okay, when we built out retirement plans, we've talked about this in the past, decumulation strategies. We operate under the assumption that as you went into retirement, you would deplete your assets.
Yeah, your assets would draw down because you're living off of it.
Guess what, folks? We're not seeing that.
We're not seeing that.
So these clients that we're working with that were worth between $1 and $5 million are now worth between $10 and $25 million. We have some clients that are worth as much as $50 million. And to our lottery-winning friends out there, we work with you, we love you. You woke up one day and you're well over $25 to $30 million.
Yeah.
Okay?
It happens.
From basically doing nothing wrong, you're worth 1 to 2, now you're worth 50. Here's why that's a problem. Because if something happened to you yesterday, guess what? You are now, if you own U.S. fixed assets, you are attracting the attention of the IRS.
Right.
In terms of it's a wealth tax.
Yeah.
That's something people didn't even comprehend 10, 15, 20 years ago.
It's true.
So if you look at, in the last 15, 20 years, where have you had the greatest opportunity to make money in investing? It's been in the United States.
Right.
That's great.
Yeah.
However, if something happened to you yesterday and you're not properly planned for it, you're going to have to pay a lot of money back to Uncle Sam.
Yeah.
And to Canada as well.
Well, and you don't want people to be surprised. And I know we still get calls and we do a lot of planning, but it's, I owe how much? And I'm taking money out of my RIF and I'm retired. Yeah, that's how it works.
Yep.
Right? And so when you don't want to get caught in those surprises all the time, it's understanding where you're at. And then again, sometimes you can adjust and sometimes, well, that is the number and you're going to have to pay tax.
It's what you say often, right? Mm-hmm. As your wealth grows, coordination matters more than optimization.
It does, 100%, 100%. That coordination is key. And we often see that. And it's not uncommon for you or I to join meetings with accountants and lawyers, coordinating all of those people, because as the individual, again, our clients are busy, they're living their lives. They don't have time to play broken telephone between all of them. Get them all in the same room, you do a planning session, we all get on the same page, and we know what the plan is.
And what does that page say? When you get everyone on the same page, what should it say? I have a view on that.
Well, and I think what it says is, have I considered these options, where I'm at today, and then also think forward, right? Because oftentimes I've seen this, they come up with these great tax strategies for the current state. But you also have to think, what does future state look like? If business continues to grow and this continues to unfold, what does that look like? Because you could spend a whole lot of time and money building something that's only going to be around for maybe a year or two.
Yep.
So I think stepping back and reflecting on that, and that's where we come in by asking questions and understanding the nuances of the individual. Mm-hmm. Again, we're not leaving it to the individual to try to figure it out. You don't have enough time in the day to do it. It's us kind of identifying that and modeling it out for them.
Let me put this in brass tacks, simplest terms, okay? Anyone that you want in your life from an advice providing perspective, you want them to understand three things. One, as it relates to money, it's hard to earn it. Mm-hmm. Two, it's hard to keep it. And then three, it's hard to grow it. So when you want people on the same page, you all have to be singing from that songbook.
Yes, 100%.
Okay? So everything matters, everything counts. And just so everyone knows, you cannot reduce tax to zero. If you make money, you're going to pay tax. It's that simple.
We're in that lose-lose situation. I find every year it's if the markets aren't great, clients aren't happy because money's down. We've lost money, right, in the short run.
Yeah.
But if you make money, we're also in trouble because now we have to pay taxes.
You know, when I was doing some postgraduate work at Wharton, and one of our profs, his name is Dr. Richard Martson, phenomenal professor, great finance professor, and one of the things he talked about was the best tax reduction strategy of all time. And we all went, what is that?
Ooh.
Don't make any money.
Yeah.
And he was an American from Philadelphia telling us.
Yeah. Well, we had a client one time said, well, I have a friend, he's writing off he has all these losses, so he doesn't have to pay any taxes. And I remember sitting there going, well, we don't have losses. Yeah. Are we in trouble?
well, okay. We have a version. Any good portfolio manager, wealth advisor, has a form of what I describe as a Hippocratic oath.
Yes.
And that is very simple. I'm not going to wake up in the morning and consciously go to work to lose people money.
Yeah.
That's not going to happen.
No.
So we use the resources of our firm from a research perspective, from a planning perspective, and so forth, to bring everything to bear for our clients, so that at the end of the day, when you wake up a year from now, especially 5 years from now, and in particular 10 years from now, you're in the problem of, thought I'd be worth 10 million, I'm now worth 20 million.
And we hear that all the time, right? Because of the compounding that's occurred, clients always remark. Yesterday morning was doing a review. They've taken out a chunk of money for renovations, their lifestyle expenses. They said it just seems to keep going up. And it's not that our situation in terms of the investments, we haven't gotten more risky or anything. It's the compounding that is literally taking hold much later in life. So to your point, this deaccumulation, we're not seeing it. The compounding is really taking hold.
Yeah. And that's a powerful force.
It is.
So the reality is, again, if you are experiencing compounding, the more you understand the difference between a tax-free, tax write-off, and tax deferral, the more you're going to understand when and where your tax liabilities are going to occur.
100%.
You need to understand that.
Yeah, 100%.
And those are the questions you need to ask your tax professionals. That's critical.
Well, and I think, again, that's the whole point of being intentional, setting time. Again, it doesn't have to be a big over-the-top situation, but it's just finding those little leakages because, yes, you want to go out and make money in the market, but if we can find simple little things to save you money in tax, that also is money in your pocket.
Yep.
Right? And so it doesn't show up on our rate of return reports that we show clients, but we know because we've done that, you have that many more dollars compounding you longer term. It matters.
So ultimately what we're talking about really is the difference between tax filing and tax planning. Right?
100%.
Right? Because when
100%.
the minute you file your taxes, the toothpaste is out of the tube.
Yeah, it's done.
Right? You can't put it back in.
No.
It's done.
Uh-huh.
But tax planning, on the other hand, encompasses all the things we're talking about.
Yeah.
Right?
So with all the energy and emotions people feel around this particular time of year, let's keep that energy and that momentum to book a time to go through that checklist. And again, I think you'll come into the next year better prepared, better organized. Yeah, this is the checklist that we're showing on the screen here. We'll put this down in the details below if you'd like a copy of it. But again, it's not overly complicated, but it's simply going through the motions and making sure you've thought.
And I think also, if I could add, when you're doing your annual wealth and tax review, you don't have to swing your circumstances around like a dead cat.
No.
You don't have to change everything.
No.
In fact, a lot of it is more confirmation than anything else.
100%.
You're just basically measuring twice and cutting once.
Exactly.
Right? But in that process, you might find a few things here and there.
Yep.
I'll give you an example. If let's say your debt to equity ratio, you've got investment debt equal 20% of your enterprise value. And let's say you basically took out that debt over the last 3 years. You might have paid a higher interest rate than you might have wanted to because rates went higher in 2022.
Right.
Well, now rates have drifted a little bit lower. Maybe it's time to review your cost of capital and say, okay, should we be reformulating our debt structure
100%.
to reflect the current interest rate environment?
Absolutely.
That's just a small thing.
Small thing.
But something something you should do.
Yeah.
This applies to everybody. If you're a senior level executive working for a firm or a corporation, you own a business, you're a lottery winner, this applies to everybody. So I'm going to pause there. Listen, if you like our podcast, please click like or subscribe.
Ooh, you
on
sound
YouTube.
like a finfluencer. Like, ring the bell.
The heck's a finfluencer?
I don't know. It's a thing.
Tap like or subscribe. We're happy to distribute our material to you. Amy?
We're going to put this down in the description. So again, if you want to reach out and find out how we can get a copy to you, check the description in the YouTube page, and we'll get a copy over to you.
And laminate it and use it every year because you tick those boxes, you're probably going to end up 5 years from now or 10 years from now with a very strong financial plan.
Yeah.
Let's go out and make some money.
Woo! Okay.
All right.
Till next time.